Okay, I think that means I can start. It says we're live, so let's go. So welcome, Chris Clothier from the Capital Gearing Trust. My name's Charlie Morris. I'm the Chief Investment Founder, etc., of ByteTree, and we do lots of interesting things in investments, but you probably already know that. So one of our holdings has been the Capital Gearing Investment Trust, and we've got the co-manager, Chris Clothier, with us. Thank you for joining us, Chris. So,
good morning, Charlie. Thanks very much for having me.
Pleasure. So could you firstly, let's just pile through some things. We're going to do about 15 minutes of me talking to you about what's happening in the trust and so forth, and then we'll open it up to our clients for any questions they may have. Okay, so if you do have a question, you can put it into the box whenever you like, and we'll hopefully feed it into the interview as we go. Firstly, Chris, can you tell us the background of the trust?
Yeah, so we, CG Asset Management, have been managing the trust since 2000, and prior to that, it was managed by Peter Spiller, who is our founder at CG Asset Management. He's been managing it since 1982. Over that time frame, it's compounded at about 15% per annum. 150 odd times your money over that period. But the intention of the trust is that it should be a defensive trust. So we're much more focused on the amount of money that we are prepared to put at risk, the amount of money that we're prepared to lose, as opposed to trying to generate maximum returns. So we're trying to generate, good returns, reasonable returns, but with low levels of risk and volatility.
Right, and by background, you recently celebrated the 40th anniversary, and I think in the document that you came up with, which is excellent, in the 80s and 90s, particularly the 80s, there were much higher returns, and that's because, as I recall it, valuations were low, interest rates were high, dividends were high. You put those together, and it was deemed to be a very attractive time to invest in equities. Is that right?
Yeah, absolutely. So, kind of a founding kind of core principle of the way that we invest money is to say, if prospective returns are good, how long do you want to lock them in for? And the obvious answer to that is as long as possible. And so, as you say, in the early 80s, P's on the S&P 500 were below 10. Interest rates, as we know, were very high. So clearly prospective returns across all asset classes were really attractive at the time. But if you wanted to lock those in for as long as possible, that meant you needed to own equities. If you fast forward to 2000, then clearly equity valuations were very high, but real interest rates were very high, and therefore prospective returns on long-dated bonds were very high, even though prospective returns on equities were low. So then we shifted to having long duration fixed income and a low weighting to equities. Today, as things stand, we think that equity valuations are high and therefore prospective returns on equities are low. Clearly, the bond market has repriced very dramatically over the last couple of years, but nevertheless, we don't think that long bonds, particularly long nominal bonds, are attractive. But we do think that short interest rates are attractive, and so we're largely parked in relatively short duration instruments. Though, we've had a period of rough performance, and I think that clearly, if you do own a lot of bonds, as we do, a rising interest rate environment is a pretty challenging environment in which to make money.
So we'll come to that, but let's before we get to all that, the present day and where it's all going, I just want to cover off some sort of structural things. There's been a bit of a change in personnel recently. I mean, I know Peter's still there in the background, but who else has joined the firm? Your Q2 report was written by Peter and Emma Moriarty. There's also Alistair Lang. So how does everyone fit into their roles?
How does everyone fit in? So, Peter is in the office every single day, and he's there at his desk at 8 o'clock. He cycles in from Kensington. So he's not remotely disengaged. But the key members of the investment team is Peter, myself, and so I've just been appointed co-CIO alongside Peter. Alistair Lang is our chief executive, but he's also a co-fund manager. And then we've got two next layer down. We've got Hassan Raza, who joined us from HSBC, and Emma Moriarty, who joined us from the Bank of England. I have to say that both Emma and Hassan are absolutely first rate, very different skill sets, bring different things to the table. Hassan's very kind of strong on the kind of technical side of things. Emma is very strong on sort of macro. And so, yeah, I think we've got a small, but I hope sort of perfectly formed team to do what we do.
In the Q2 report, A Brave New World, you talked about these sort of regimes that go on for much longer than we expect. You know, we've had the gold standard, the Bretton Woods, the Volcker inflation period, the Great Moderation. And you talk about the current period, and it says, you know, higher interest rates will impact companies' balance sheets from both directions. Higher interest rates will reduce asset valuations, and they'll, gearing ratios will have to come down. Debt servicing will have to go up. Not only will it cost more to debt finance, but will also reduce the availability of debt, which is something that we haven't actually seen yet in markets. And the appropriate balance sheet for the future will be much less leveraged than it's been in the past. Now, reading between the lines, this is why your fund is defensive at the moment, very high on fixed income, even as a rate rise environment, and pretty low on equity. I think, can we start, the fixed income is kind of the elephant in the room, we'll get to that. Can we just start with the risk part of your portfolio? What risks are you taking at the moment?
So we are about 28% in risk assets at the moment. And for those of us who don't know us, we tend to, we're not stock pickers, so we don't buy individual equities. We tend to get most of our exposure to risk assets via the investment trust market. And what we have a long history of doing successfully is buying investment trusts on discounts, where either we think that discount will mechanically close, or where we can affect change and make it close. So that's kind of a core part of what we do. So at the moment, of our 28% that's in risk assets, 15% is in conventional equities, and that is in a mixture of equity investment trusts or ETFs where we can't find a suitable investment trust to purchase. We've got two kind of strong bets in our equity allocation. The first is to Japan, where we think that both Japanese equities look very reasonably priced, and we think that the yen is extraordinarily cheap. And therefore, we think that, one or other of those elements of value is likely to prove, very profitable over the medium term. And then the other relatively large bet that we have is in energy stocks. And essentially that is a combination of the fact that, whether we like it or not, the world is going to continue using oil in relatively large amounts for the next decade, a little over 100 million barrels of oil per day. But CapEx and exploration in the energy sector has been, way below what's required to replace that for the last decade. And that valuations are incredibly undemanding because of the fact that oil stocks have been sold for ESG reasons. And so we think that, the likes of Shell and BP and so forth offer very attractive returns. So that's in our conventional equities. And then we've got our next biggest holding is in infrastructure. We've got about 5% of the portfolio in infrastructure, both renewable infrastructure, social infrastructure, and hard infrastructure. And then we have about 3 or 4% in property, and then a few other kind of little niche bits of speculative grade credit and those sorts of things.
I mean, if you look at those areas, I mean, you could just say bad luck. Energy been a great theme recent years. The last year, not so good. But when it comes to things, and Japan, I mean, I don't want to go into Japan as a conversation, and we're talking a couple of percent of your portfolio. But yeah, I broadly agree with what you're saying. And but when we look at the sort of infrastructure funds and the solar and the wind, these are all income funds, aren't they? And
they are, yeah.
I mean, traditionally, I'd expect the capital gearing investment process to buy things on hefty discounts. But you kind of did go into this year with some of these holdings on premiums. And, whilst your bond book was really short duration and incredibly defensive and, well played, that sort of duration sort of crept in through these funds. I mean, why do you think you were happy to own them at premiums?
Yeah, and I think, and that's, Charlie, that is a fair criticism. And I think that's a very good analysis. why were we happy to own them at Premier was that we have felt for a long period of time that inflation was likely to be much higher in this current period than the market was expecting, and also likely to be sustainably higher in the future than the market was expecting. And so when we analyze these infrastructure assets, we looked at the inflation forecasts that were implicit in their valuations, and they were generally between 2 and 3%. And we felt that those were very low. And we also felt that at some point the market would come to the same view that we have, which is that inflation is on average going to be significantly higher for the next 20 years than it has been in the past, and would come to value these cash flows very highly because of their very strong inflation linkage. And I'm afraid to say that we got that wrong. And so the same thing is true, albeit to a less extent, in our bond portfolio, where index-linked bonds, even though we've been in this very strong inflationary environment, the break-evens, which is, roughly speaking, the market implied forecast of inflation, have come right back down to essentially 2%. So saying that the markets are saying that, no, don't worry, this whole inflationary issue is going to disappear within the next year or two, and then we're back to an era of low inflation in perpetuity.
Fine, let's go straight to that then, because I think that there's a few other things I do want to get through, but I think why inflation-linked bonds have not worked compared to conventionals is a big story in markets.
Yeah.
And one of the theories is that when the inflation swaps are being priced by the banks, they literally just listen to the central bank, and the central bank says 2%, and so they price them at 2%, which is extraordinary. And that's something that many of us have only learned recently, that's how it happens. It could be that we have no idea. That the bond market has no idea about inflation. Actually, it's all about interest rates. And I think we were all brought up being told that it's the bond market was interest rates and inflation, but it just seems to be interest rates and not inflation. And so these are some strange old things. And why do we think that the break-evens, the implied inflation in the bond market, is just discounted and ignored? I mean, what's the thinking at Capital Gearing of must have done some soul searching. Yeah. We all have.
Yeah, absolutely. I mean, so I think there's a couple of reasons, and I think the one that you were kind of alluding to there is possibly correct, which is that there's this curious circular argument that goes on in macroeconomics, which says central banks plucked an inflation target of mostly 2% around the world, give or take, out of the air. It was, the New Zealand central bank was the first to do it, and then everybody else agreed that was a good idea. And so they summoned this target, and they then said, they then said that, well, inflation will always come back to target, provided that inflation expectations are anchored, and inflation expectations are then are anchored because of the targets that the banks have. And so, as you can see, that's a kind of an entirely circular piece of logic, but it is one that for the time being is kind of self-sustaining because of the fact that, after all, this all relates to psychology, and provided that people believe it, then, it will be the market price. But what's really interesting about that is that if you go back over the last 20 years, inflation-linked bonds have massively outperformed nominal bonds. And we spend a lot of time analyzing why that might be the case. And the single biggest reason that we can find is that actual inflation has been a lot higher than expected inflation over that period, even though the last 20 years has been an era when inflation has been, really pretty moderate and pretty under control. So I guess that, yes, you're right that the market seems to price in, forgets about the possibility of inflation in pricing both nominal and inflation-linked bonds. But one of the nice things is that at least that's all in the price. So therefore, if, like us, you hold inflation-linked bonds, and if inflation is indeed a bit, is on average above target over the coming years, as it has been over the last 20 years, then you will do much better by owning inflation-linked bonds. And then there's the possibility, which is that you get a real kicker if market psychology changes and you do see those break-evens expand.
So what do we think about the CPI data earlier this week, which I think came in at 3% from memory, and straight from 9 to 3. Some people say the last 12 months we've got the base effect out of the equation now. The sort of Russian oil surge is now out, and that's it. Some people think it's straight back to 2%. I mean, what's the sort of view at the house view where you are of not inflation but the outlook for rates?
So prior to this month's print, core inflation was averaging for about the past 6 months 40 to 45 basis points per month. So that's sort of pointing to core inflation of about 4.5 to 5. And then this month's core inflation came in at 0.2% month over month, e.g. kind of annualizing, 2.5. Now, there were a number of one-offs in this month's inflation print, but on the other hand, it's careful. You've got to be data dependent and not exclude the things that are inconvenient to your thesis, if you know what I mean. So I think that undoubtedly you would say that core inflation is on a glide path down. And obviously the base effects are going to, but it won't be long before the base effects, headline inflation is significantly below core at the moment. And so obviously those will start to wash out the back. And so you'll see headline inflation rising back up towards core over coming months. I think that at heart, though, it's very hard to see core inflation coming down to the target of 2%. Apologies, my phone was switched on. Unless wage growth starts to come down quite a lot. So average hourly earnings is at 4.4%. That's one measure. At the Atlanta Fed wage tracker is at 6%. And I think the employment cost index is about 5.1. So that kind of gives you a range for wages in the US. And, ultimately, we think wages are the biggest driver of inflation. And so for as long as they are as high as they are, it seems jolly unlikely that inflation is going to come down to target. I saw that Bridgewater Associates, the big hedge fund in the US, have come out with much the same statement, which is to say that, squeezing this last bit of inflation out of the system is going to take quite a long time.
Yeah, and of course we've already had the commodity bear market, certainly in time and probably in price, and so it's hard to see in the absence of a global depression, commodities giving much more back. Yes. Move on. So basically, we've covered the fact you've got loads of bonds, and being inflation sensitive hasn't been particularly helpful in your risk on or your risk off bucket of your portfolio. So there's been a bit of attrition there. But going forward, most of the rate hikes are probably done. Yeah. So it can't get any worse. But let's move to discounts. Firstly, your discount, and then I want to come on to the discounts of the investment trust sector, closed-ended company sector in general. So your discount, you're doing buybacks. Why is there selling pressure on your trust? But generally, historically, it's been buying pressure has been the prevailing wind.
Yeah, and so in the 12 months to December of 22, and apologies, I don't have this number to hand, but I think that we issued of the order of £400 million of equity in the trust, and with the best will in the world, I think you'd have to say that some of that money was not going to be long-term money, and indeed we've seen that. But then I think what's also true is that, we put our hands up, our performance hasn't been fantastic. So on a 12-month basis, we are down at an NAV level, 2.9% total return. But obviously, because the shares have swung from a premium to a discount, so we have a zero discount control mechanism, which means we issue shares on about a 2% premium and buy them back on about a 2% discount. That's a 4% swing. And so if you put those two things together of a negative 3% NAV performance plus 4%, that's negative 7%. And so people who've bought us as a defensive stock are saying, gosh, I'm down 7%. Well, there's clearly something wrong here. And so I'm going to sell. And so, I think that's what's happened.
Okay. And And is there something wrong that we don't know about?
I mean, yeah, I mean, obviously, I'm going to, undoubtedly, we've made some mistakes, and I think you've highlighted them really, which is to say, we've had a too high a level of interest rate sensitivity, particularly on the risk asset side of the portfolio. But I mean, the thing that I really think is that sitting today, now, of course, I can't predict the future, and I can't say whether or not we're going to make money over the next 12 months. But I can say that the probability of us making money is so much higher than it has been at any time over the last 10 years. Why is that? Well, because all of a sudden we're in a much more, what I would consider normal interest rate environment. And so, we have 30% of the portfolio in dry powder. That dry powder is mostly made up of sterling treasury bills and sterling corporate credit. Well, we've just had the Friday T-bill auction this morning, and the average rate was a little over 5.7% on 6-month treasury bills. Similarly, our credit portfolio, which is short duration, about 2 years duration, investment grade, is yielding about 7%. So, there's just this kind of fantastic support for returns coming from these much higher interest rates. Now, of course, getting to these levels has been very painful because, continually as rates are rising, then the value of your assets is falling. But eventually that comes to an end, and at least then you're enjoying the much higher yields. And then hopefully over time, they'll start to provide a tailwind performance.
I think your dividend yield last year or 2 years ago was just over 1%, wasn't it? And today it would be, looking forward, estimate, we're not allowed to say.
I mean, I put it this way: if you multiply, if you annualize the amount of revenue we've earned since we paid the last dividend, declared the last dividend, it would be about 3%. Okay. I'm not making any forecasts.
But forward looking, so forget about that, just that. Is that sort of thing? Something
of that order.
Yeah. So I think that is, I mean, I know you probably can't say it because you need to have the reports and all the rest of it and the audits. But I think that what you're saying is that all your instruments, the prices have gone down, the yields have gone up. And so we can think of you as a pretty stable place for cash. And with cash-like visibility compared to a year ago. Not that I'm saying you're a cash alternative, I never said that. So could we also talk about the discount, the wealth management sector? You've got some big mergers, Smith and Williamson getting together with what they're called. And, these people, they've got these enormous firms, far too big to manage money properly. And what's happening there with ownership of your trusts?
In
general.
So obviously the big merger that's been announced recently is Rathbones getting together with Investec, and those two probably are the two largest owners of the investment trust sector. And so, for example, there's a few well-flagged funds. So, I think that they would have a combined, of the order of 50% of BH Macro, and clearly then once that merger has happened, they won't be able to buy any more BH Macro shares without a whitewash, because otherwise they'd be forced to make a bid for the entire company and so on and so forth. So clearly that's problematic. I mean, I think the thing that we are seeing at the moment is, and it's less to do with wealth managers, is that you're seeing, kind of a global macro call, which is to sell UK mid-cap because the UK is perceived as being a vulnerable economy. And so then when you sell the FTSE 250, you're selling a lot of investment trusts at the same time. And so, as it were, somebody sells the FTSE 250 ETF, the operating companies go to the legal and generals and, UK real money. And then the alternatives and investment trusts would historically have gone either to the big multi-asset funds that are run by the likes of Baillie Gifford, Schroders, Newton, and so forth, or to wealth managers. Well, the big multi-asset funds are mostly seeing redemptions at the moment, so they're not a natural buyer. And then the wealth managers are saying to themselves, well, I can get a tax, as near as makes no difference, tax-free return of 5.25% by buying short-dated gilts. Why would I bother with this alternative income stuff? And so that's why I think we're seeing, the infrastructure stocks, the likes of HICL, IMPP, Greencoat, which I think are very high quality names, on discounts of 20% of their NAV.
Sure. Okay. And any problems with regulation in investment trust liquidity, or has the market managed to absorb all that?
I mean, I think that the cost disclosure rules, which have been, well publicized, are not helpful. And so, this, for example, means that if you own Greencoat, which owns, a lot of wind assets, you're forced to record in your fact sheet whether you're an investment manager or a wealth manager, the management fees and various other costs. But conversely, if you own SSE, which is a developer and owner of wind assets, you put in a zero. That's clearly, but clearly there are costs associated with running both of those businesses. The cost of running SSE is clearly not nothing. And so that was a rule that is a consequence of the kind of the Kidd Prips rule. And I've been really encouraged to see Baroness Bowles taking up the baton very vigorously to say that this is a silly state of affairs, and that the guidance on this needs to be changed. Whether or not it gets changed, it remains to be seen. That would clearly have a help to the sector.
Okay, thanks, Chris. Now I'm going to round off fairly soon. So could you please get your questions into me if there's something you'd like to ask Chris before we go. There's something that came in right at the beginning of the interview. I hope that I've answered that. Performance has been disappointing. I think you've covered that. And going forward, there's lots of yield to look forward to in a pretty defensive portfolio. Briefly, why do you not have way more in equities? I mean, why is your risk weighting one of the lowest it's been in history?
I mean, the short answer is that we think that US equities are very expensive, and history shows that when the US equity market takes a dive, correlations go to 1, and all risk assets around the world sell off, regardless of whether or not they're reasonably priced today. And if you look at the FANG Plus index, that's gone up by 75% this year, and it trades on 40 times earnings. And the FANG Plus index, an equal weighted index of Meta, Apple, Nvidia, Tesla, et cetera, and actually that's seeing sales and earnings decline this year over last. And so for an index that is not in aggregate growing, 40 times earnings seems like a pretty rich price.
Fine, perfectly reasonable. I don't think we're in huge disagreement. So the last question I'm going to ask you before I hand over to the excellent questions coming through thick and fast, I'll give a bit more time for them to come through, is the pound. The pound is surging and the dollar is sinking.
Yes.
What do you make of that? I mean, the pound, you could say the pound at 130 feels awful, but of course it was only in 2007, it was 210 to 1. So, how far can the pound go? It's painful for owning overseas assets. And what do you make of it?
Well, the first thing I'd say about the pound is that, let's take the long sweep of history. 100 years ago, the cable rate was 4 to 1. It's now 1.3 to 1. So sterling, it's been basically a one-way bet for 100 years, and I see no reason why that should change. And that basically boils down to the fact that I think that the US economy is more productive than the UK economy, and I don't see that changing. So that's a sort of a big picture. I think you want to have a reasonable portion of your assets in overseas investments, and that's what we do. I think that sterling at the moment, I think, is being pulled in two directions, and if I'm honest, it's very hard to see how they play out. On the one hand, UK, exchange rates for most of the last 15, 20 years have been driven by interest rate differentials, and so countries with the highest nominal interest rates have stronger currencies. And clearly, we've got a bigger inflation problem here in the UK than, say, in the US. So therefore, we're expected to have higher interest rates, and therefore sterling is strong and will go stronger. On the other hand, I see the fundamentals of the UK economy as being much less strong than, say, the US, and therefore that would argue for a much lower exchange rate. So, I would. We don't speculate on currency. We have kind of long-term kind of currency views. But if you were going to kind of put a gun to my head and say, what do I think is going to happen? I would say probably I would see some continued strength in sterling over the short term, but over the kind of medium term, I'd expect sterling to be, a good chunk weaker.
Yeah, and there's one other thing, I suppose, is that you tend to associate sterling going up with bull markets, and we've got this mystery bull market going on. Okay,
and I'd say, and that's another really good point. A core part of our history of delivering pretty stable returns has been just that relationship between risk assets and the cable rate.
Right, quick fire round. We're going to do some questions that are coming in. So how are you differentiated from the Rougher investment company, which I'm doing next Friday with Duncan, and the Personal Assets Trust? We haven't asked about it on because we haven't recommended him, which I shouldn't really publish it, but we like him and it very much.
I think the first thing to say is that intellectually speaking, and in terms of what we're trying to achieve, I think all three trusts, Personal Assets, Rougher, and ourselves are very similar. And I think, they're all very, very sensible investments.
Similar objective, different implementation.
Absolutely. So with Troy, you have, Personal Assets, you tend to have a higher proportion of gold, and you tend to have sort of quality American equity portfolio, and that's what distinguishes it from Rougher and ourselves. With Rougher, you have they have explicit hedging strategies, and so they spend a lot of money on protective options and those sorts of things. But obviously, hopefully, those things pay off quite powerfully in risk-off environments. We Capital Gearing Trust are long only. And so we don't use any derivatives, we don't do any hedging, but equally, we're not spending the money to buy that. So I think that probably, Rougher probably will protect you a little bit better in the kind of the really nasty moments. But on the other hand, that does come at a cost over time.
Sure. I would add that I think, Personal Assets has got a very high quality, highly liquid portfolio. And your portfolio is probably a bit less liquid. Most of it's liquid, but some of it's not liquid. And then probably got the most complex portfolio with derivatives and stocks and that sort of thing. Okay, the charges. Capital Gearing Trust, you don't charge much, do you? How much is it at the moment?
45, 50, that sort of thing,
0.5, something like that?
Oh, sorry.
The charges, AMC.
Oh, sorry, charges. I beg your pardon. Yes, a short 0.5.
Yeah, 0.5. So good value for money.
The average management fee is about 36 basis points.
0.36, yeah. It's non-greedy compared to many others. The infrastructure trusts generally value their assets at NPV and, sorry, I need my glasses for this. Can you see it?
Sorry. Yes, I can open up the questions. Absolutely. I'll have a look. So the infrastructure assets generally value their assets at NPV and not book or realizable value. Do you feel that a discount is not justified when NPV is used and not true NAV? I think the thing that's really interesting about that is that I think that private markets have held up very well. And so actually, where you've seen transactions going on, they have tended to happen at pretty close to book value. And when we talk with the managers of these infrastructure vehicles, we quiz them on this very extensively, as you would imagine. And so I think there is a genuine disconnect between public markets and private markets at the moment. How those play out and which one moves towards the other, I guess, remains to be seen.
Lots of supply, big deficits from our governments in America, in Britain, elsewhere. What is the impact of lots of new bond supply on markets?
I think you'd have to say that yields are likely to go up, aren't they? I mean, that just simple supply demand. Yeah, I mean, so the gross refinancing requirement for the UK government's about 230 billion this year. Net, it's a little over 100, plus the Bank of England selling about 8 billion of gilts a month. So you're sort of looking at something of the order of 130 billion of supply of gilts that needs to be absorbed by the market. That is one of the principal reasons that even though we think that real yields in the UK linker market, which, having thought that they were frankly horrible and uninvestable for most of the last 5 to 10 years, we now think they're genuinely attractive. But our duration in the linker market in the UK is only about a little over 3 years, precisely because we're twitchy about that huge wall of issuance that is to come.
What are the major risks in the portfolio now? What's the downside, max downside?
The max downside comes from interest rates going significantly higher than the market has forecast over the next year, or a very strong rally in sterling. Those would be your two big risks.
So pound up a lot, interest rates up a lot over here. We'd see a bit of downside, but you would be cushioned somewhat by the sort of 6% yield that we've already got.
Correct.
Yeah.
Correct.
You say equities are overvalued, but does this not actually generally apply to large caps versus small stocks and so on? So I think you've mentioned small caps. And I've written about small and mid caps before. If you don't mind, I'd say it's liquidity, I think, is the issue there. But yes, there's more value in large and small. Anything you'd like to say about that? The stock market, obviously you've got the big seven fangs, and you've got the rest of the world, and then you've got the small, not everything's a bubble, obviously, but you're not playing in a big way right now.
Yeah, I mean, so what relatively small amount we have got in equities, we have positioned into markets that we think of are cheap. So yes, it's UK small cap, it's energy, it's Japan. But we're very mindful of the fact that with 60% of global stock market or global developed stock markets in the US, if the US takes a tumble, everything goes with it.
Yeah, well, it would be a first if it didn't, wouldn't it? Andrew says a weakening dollar should drive US markets higher. Give with one hand, take with the other. Given that you are bearish US equities, do you therefore not think the US dollar will weaken in the medium term? You're dollar bear. You're sterling.
Yeah, I'm long-term bearish on sterling relative to the dollar. I think that I'm not sure. If I'm a bear on the dollar, I'm not sure what I'm a bear of it against. To quote Larry Summers, as I think my partner Alistair did in his quarterly, Europe is a museum, Japan is an old people's home, and China is a prison. I think that the yen is fantastically cheap. I don't have a strong view on the euro. So what does the dollar depreciate against? I think it is possible that the dollar depreciates against hard assets. So I think that you could see, commodities and gold doing well against the dollar over time. But we're not a dollar bear. We see it as being, central to the global financial system for a long time to come.
You've handed that to me on a plate. So you've written 3 or 4 articles slagging off Bitcoin, saying it's sort of Ponzi and cat sick and whatever else you said about it.
Absolutely, Charlie.
I mean, you're obviously wrong on that because Bitcoin's still.
Yes.
And what would you need to change your mind?
You know what? The real thing about it, Charlie, is that is for me, I look at the energy consumption of Bitcoin, and I just think that is the ultimate potlatch in this world where we need to decarbonize. The idea of using energy to the vast amounts of energy to run, frankly, a really rubbish payments network just seems, it just seems kind of offensive to me. And also that it's, it is essentially used for illegal activities, and it facilitates, child pornography, it facilitates, really kidnapping, ransoms.
It's a really bad way to do those things because it's traceable. But anyway, we'll take this offline. Suffice to say, I completely disagree with you. And there's a question here. So RIT Capital, RCP, it's in the same gang as capital gearing, Ruffer, and personal assets. I mean, as a one or two others, I mean, it's a family office mandate, isn't it? So that's the Rothschild Family Trust. and lots of private equity in there. Probably the most illiquid portfolio of all those four mentioned would be RIT Capital.
Yeah.
And they do a bit of Ruther type derivatives as well as fund selection and this sort of thing. And it's trading on a hefty discount now, isn't it? Along with, and Caledonia would be another one in the same sort of family.
Yeah.
I'd say that, you know, the three, you know, the CGT, RICA, and PNL, I would think as liquid underlying overwhelmingly, and Ruther and RIT Capital and Caledonia less so. Would you have any other comments than differentiation? Would you put yourselves in the same gang or not?
I think your analysis is completely correct. You know, you should view Caledonia and RIT as family offices that you're tagging along with, and they've done a very good job over the long term. But as you say, there's less certainty over the value of their assets, and there's much less liquidity in the underlying assets. I think that, you know, if you observe the behavior of RIT Capital, which is that they've been buying back shares pretty aggressively recently, you know, we have purchased some shares in RIT Cap alongside the buyback, essentially, and the reason is that, you know, we have put some fairly hefty discounts on some of the more speculative parts of their private equity portfolio. And so I say speculative, that's, you know, that's not to say they aren't good investments, but, you know, quite binary outcomes, I would think. And we still came back to them being on a reasonable discount even after those adjustments. And obviously the long-term track record has been very good. So, you know, understanding that it's a very different beast to us and personal assets and Ruther, I think there's a place for them in people's portfolios for sure.
Yeah, I think that if the discounts get it good enough, then they'll probably end up in our portfolios as well. Look, Chris, thank you so much for your time and for answering all the questions that ByteTree readers and clients, I prefer to call them, have answered you. So I think they're very satisfactory answers. I think that the elephant in the room is that it's an extraordinary time for interest rates, and your portfolios go from a 1% yield to a 6% yield, even though you didn't say it. And that does fundamentally change it. It keeps it pretty stable. It's pretty simple going forward. And then I guess the next chapter is, you know, what you guys do next. But I guess the current chapter just sort of drags on for another few quarters, doesn't it? Until we see some sort of major change in the outlook.
Yeah, I think that's absolutely right. You know, we're in a kind of, hopefully in a stable position where we're going to generate, you know, some reasonable positive returns from here, and awaiting better opportunities in equity markets. Charlie, thank you very much indeed, and thank you for being so gracious about not tweaking my nose too hard on the Bitcoin front.
Okay, I owe you one on that one, but we'll get to it another time. Chris,
excellent.
Capital Gearing, thank you.
Thanks very much indeed. Bye bye.